Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, December 2nd, 2016. I have quite a bit of material to cover, so I'll move relatively quickly. First of all, the stocks are hitting all-time highs, although QQQ is underperforming somewhat. We will look at some of the sectors that are leading this move higher and some that are lagging this move, but I think it may be an opportunity. We'll look at bonds, which I think could be there could be bottom in action right now. Look at the US dollar, and then also at gold, which could be set for a bounce. Oil is at 52-week highs, and we'll see where that leaves us. Natural gas also at 52-week highs. And finally, we'll take a look at sugar, which is touching the 200-day moving average. Alright, let's start with stocks. The S&P 500 ETF SPY total return index, which means that the dividends are added back into the price. We did hit all-time highs here on Wednesday, so this is showing excellent appetite for risk. However, of course, you can see that this move was quite strong, so some give back is absolutely normal. So we could retest the breakout levels at 218.50, maybe 217.50, but I don't think we're even remotely close to entering any kind of bear market. We're firmly in a bullish market currently. Advanced decline line, advanced decline volume line is also in a positive, or rather confirming the all-time highs. And as mentioned last week, we're not yet even that terribly overbought. So overall, I think the markets could continue higher, especially if we see a little pause and then maybe a continuation higher. Here is the S&P 500, a little bit longer term time frame. First of all, I have a market breadth index, my proprietary market breadth indicator, which shows that we have entered the bull market back here in June, and we are still firmly in a bull market territory. We were somewhat oversold according to one of my another proprietary indicator, percentage of stocks within an uptrend, but I think we are coming back up basically, and this oversold condition was an opportunity to buy. As far as long term, we can see some of the longer term indicators here. Percentage of stocks above the 200-day exponential moving average. You can see it moved into above 60% here back in May of this year, and the same goes for bullish percent index. We moved above 60% back in April of this year, and we're yet to break even below 50 on both occasions, in both indicators. So we're firmly in a bullish territory, and I don't think there is any kind of indication that we are going to be rolling over into a bear market. Overbought does not mean weak. In this case, overbought is actually a sign of strength. So here's a weekly time frame for the same S&P 500. All-time highs. We did hit all-time high intraday on one of the days, as I mentioned. But like I said, this whole support break here, I thought we were going to have a support break and maybe retest the Brexit lows back here, but this did not occur, and we negated the support break with a sharp move higher and a all-time high. So to summarize, I think the S&P 500 and vast majority of stock funds in the United States is bullish, and we could easily see fresh all-time highs following maybe consolidation of some sort. The Dow Jones Industrial Average also hit all-time highs this Wednesday rather, but there was barely any selling for the Dow. Whereas S&P 500 came under some selling here. You can see a little bit of a loss. The Dow really did not feel much selling. So it is a bit overextended. So possibly will come down and maybe retest this breakout. but it is definitely not going to be the end of the world, and in fact it could be a buying opportunity. So there's a little bit of a divergence here. This unbalanced volume hasn't confirmed yet. The advanced decline line did confirm for the Dow, but no advanced decline volume line has not confirmed yet fresh all-time highs. So maybe we'll come down a little bit and then continue another leg up will ensue. Okay, so where is this weakness, if there is any, being felt? And of course that is in technology sector, in power shares QQQ here. You can see it's underperforming the general market quite strongly. We have not yet made a higher high. How much should we worry about this? Not much, honestly. I think we are very close to all-time highs. And this pullback is a little bit, it's kind of normal occurrence. In fact, if anything, this could be a buying opportunity. You can see the top 10 holdings of QQQ account to 51% of the index. Google is counted twice, so I put 11 stocks here, but Google is counted twice here. So I honestly, I don't think there is much to worry about. I would get kind of a little bit worried if it maybe break below 200-day moving average and maybe like move lower towards the Brexit lows, but we're not even remotely close to that. In fact, I wanted to go and compare what's the difference between QQQ and XLK, and why is QQQ not hitting all-time highs while XLK did hit all-time highs just this week. So there is very minor differences, but apparently they are enough to account for significant outperformance of XLK versus QQQ. There is Visa and IBM and Verizon here, and there were not and AT&T as well. So also the top 10 holdings account for 63%. So this one is even more top heavy than the other one. So where is this weakness? Weakness was in semiconductors. Thursday we had a big drop here, and actually it was under pressure all week. So semiconductors came under pressure. But again, correlations between the various sectors, stock sectors, are quite high. So again, this could be a buying opportunity, if anything. Okay, so that's with the technology sector. Now, when we get to bonds, I'll show that maybe this move in financials is a little bit, just a little bit overextended. We did hit all-time highs. This is a weekly chart. This is financials in a weekly time frame. So financials did hit all-time highs. Bonds did drop a little bit more this week, but overall I think bonds are attempting to bottom, and financials are the most sensitive to interest rates. So should interest rates start moving lower again, financials could be under pressure. Nevertheless, financials are a big part of the market, general market, so a move up in financials is a positive for the general market. Here's industrials, somewhat of a similar picture, but you can see that candlesticks are kind of getting smaller, and the momentum is being lost, which is again absolutely normal. Markets never move in a straight line, and eventually the profit taking will commence. So maybe we'll already see in the beginning of that. So we could see consolidation, sideways consolidation, maybe even a pullback to the breakout level. I think energy was the biggest mover for the week, and I'll get to oil eventually, but these are 52-week highs. And correlations between the various stock funds is actually surprisingly high. And if we put a correlation coefficient on energy, you can see it spends most of its time in the positive territory. It was seriously underperforming the general market because these are 52-week lows, actually multi-year lows. But the correlation-wise, there's still they're basically moved together. So a move up in energy is entirely possible, with or without the cut in oil production from OPEC. Here's the material sector, same thing, also hitting all-time highs. So this is showing good appetite for risk, because this is one of the higher beta stock sectors out there. Okay, now we're getting to some of the sectors which are underperforming the general market, but they are by no means bearish. They are still bullish, I think. It's just that they are somewhat underperforming the general market. So here's one of them, that's consumer staples. It's been sliding for the past few months, but I think it's kind of bottoming out, and there are some signs that, like for example, I can see there are 4 candlesticks for the past week. Basically, we did not go below, this area around $50.25. So if anything, I think this could be a buying opportunity. Now, as far as performance is concerned, this is more of a value investment. So let's say you do buy down here, maybe it will go up, but it will not go up as much as technology or as much as industrials. This is a lower beta sector. And you can see the correlation coefficient is still quite high. For my taste, this is for all practical purposes highly correlated. Here are the utilities, same thing. Occasionally we do get negative correlation. In other words, when utilities are moving, in this case they were moving down, the stock market was moving up. But by and large, utilities correlate highly to the general market. Again, for my taste, this is highly correlated still. So same thing here. I think utilities, there are also signs that utilities are bottoming out here, and I think we could see a rally in utilities, especially if the bonds at least hold support and not drop. And here's real estate. Again, same thing. I think that real estate is relatively highly correlated to the general market with an occasional negative foray. So again, I think that we're kind of bottoming out here, and if the bonds do not drop anymore, or at least just hold steady, I think we could see a rally in the underappreciated sectors that I just mentioned. Okay, here are the bonds. This is TLT, the Treasury's 20+ year Treasury bond fund. Even last week, if you watch my video, I thought this was already like a bottom in action. Now this week we still were, we dropped lower, but I still think that this is a sort of a bottom in action here, and these are all hollow candles here, and there are tails out of the bottom here. So, and there's also quite a bit of volume. So I think there is a good reason to think that we're going to get a bounce in the TLT, because we have this big gap here that needs to be closed. So it would not be completely out of the ordinary for TLT to come up here and maybe retest this high, this area at 130. For the record, I think TLT and bonds have turned bearish in the long term. So I think that longer term we have had a reversal here of the all-time highs, and approaching next slide. I show some of the bond funds are actually approaching and hitting a multi-year and 52-week low. So for now, TLT, this is not a 52-week low, but still. For now, I think we can see bottom in action, maybe sideways consolidation, and possibly a bounce higher. Here's TLT on the weekly time frame. These are still all-time highs, and we have not gotten to the 52-week lows. 52-week lows are still down here at 115. We did have a support break, and I think we did turn bearish. But again, I think that we could see a bounce to at least retest this levels, 125. Here is those levels, 125. Maybe even higher to retest these levels here at 130. Here are those levels at 130. Here's the HEG, the more diversified fund. Notice here the 50-day is still above the 200-day. Here we did cross below. Although I think that cross down or death cross, bearish cross is most likely imminent here unless we see an enormous pop and we start trading up here, which I don't think is going to happen. But again, same thing as TLT. I think there's bottom in action here. You can see there's several rejection spikes on relatively high volume, so we may see a bottom in here and maybe a maybe like a rising wedge, or maybe sideways consolidation. But I think, you know, also this gap needs to be filled eventually. Here's that same chart on the weekly time frame. This one is exactly at support. So basically we broke out in the beginning of 2016 to fresh all-time highs following this consolidation, and we just gave the entire breakout back, and we are now back at retesting this breakout. Now I know that this is a very large move, but nevertheless this is, you know, according to this chart, this is what's happening. So it would make sense for at least some sort of a sideways consolidation, possibly a bounce higher. So there's this level at 109, there's this gap right there, so that's one of the levels to watch on a rebound. And of course the bigger one is maybe we'll get back all the way to 110. There's that level. Some of the funds that completely unraveled are municipal bonds. Actually really came down hard and sold off really hard. There's TFI, here's MUB, and National Muni Bonds ETF. These are multi-year lows, even below the 2015 lows, so extremely strong selling pressure. But look at this volume. It's possible we're gonna bottom out, and same thing, I think we are extremely oversold, so we could see a rebound. Here's one that I mentioned the last time. Sometimes they really do ring the bell at the top. This volume up to this point was the highest on the chart. Here we can see that the volume is exceeding even this volume, and then this volume is an enormous volume. So another thought, you know, another reason to suspect that we're bottoming out here is because of this enormous volume. So these are 52-week lows, but you know, at the time I saw that we hit all-time highs here in the beginning of October on really big volume. So this was a big red flag to me, and you know, this was very concerning to me at the time. But right now I think we could see a general rebound in bonds. Finally, as far as the bonds are concerned, here's the junk bonds, high yield ETF. This one correlates highly to the general stock market, and I keep saying this over and over. So I treat junk bonds as an extension of a stock market, and junk bonds just hit all-time highs a couple of, you know, basically a few weeks ago, and we came back down exactly to support level. Very interesting. So I think junk bonds could easily hit fresh all-time highs, especially if the stock market continues higher. So here are the junk bonds in a weekly time frame, and you can see that they correlate highly to the general market, sometimes even better than the utilities, for example. So you can see that basically all-time highs and a pullback, and now we're attempting to recapture all-time highs. If we do roll over here and maybe make a lower low, maybe there will be a little bit more reason for concern, but right now to me this does not look very concerning. In fact, this is quite bullish. Right, moving up to the Forex universe. This is US dollar on the daily time frame. So we broke out and hit 13 plus year highs last week here. Basically this week we are more or less consolidating in a sideways manner. And when we get to gold, I'll explain why this is important. So far I did not see a breakdown below this 100.7 or so level, because we have 3 rejections here. But this last Friday's candle doesn't inspire confidence too much, so we could see a deeper pullback. And actually this is completely normal again, so we could see a deeper pullback to, let's say, 99 level. Here's the weekly time frame. Now tentatively I think we had a breakout out of this almost 2-year consolidation. But this is still a tentative breakout, and maybe we'll see something along this line. So we see a breakout, a pullback, and then continuation higher. So far, I guess we are seeing a breakout. Maybe we'll get a pullback and then a fresh 52 and multi-year highs and continue higher. The depth of this pattern is around 9%, so we could see at least 9% move, but most likely it will be higher if a true breakout does occur. Here's the euro versus US dollar. Last week we hit 52-week lows. We were overextended. This was an extremely steep move, all red candles, so it was normal to see some bouncing around. I think euro could, we could come back here to 108.48 and maybe even higher to like 50-day moving average here. So retest of this breakdown could occur, absolutely. Euro on the weekly time frame, quite bearish chart. I keep saying this. Big drop, bounce, couple of rejections here, and then 52-week lows just last week. But as it normally is, we see 52-week lows hit and then pull back. 52-week lows are hit and then we pull back. So it would not be surprising to see a pullback in euro. British pound versus dollar. I said that we're oversold here, so we are bouncing higher. We're approaching the first major resistance here. We have 1, 2, 3 breakdown. So we could see similar action. We could see maybe it will be hitting against it. Maybe we'll break out above this level, but then there's tons of resistance at 13445. Around here 1353, because by then also the 200-day will come in there as well. Overall, long-term British pound is in a long-term downtrend, but we could see a move up. This is the level I'm talking about, 1286 here, and then 1344. So I don't think it will go above this area. US dollar versus Japanese yen, pretty strong move up, but probably getting ahead of itself. So same thing, we could see a consolidation for Japanese yen before a continuation higher. The reason why I think that is going to happen is because this is a longer term time frame. So basically Japanese yen was appreciating here, but then it stopped appreciating and reversed. So we had a bottoming action and then a rejection of lower prices for the US dollar, and the US dollar started to appreciate. So definitely a strong move, but I think we're overextended, so we could see either a pullback or maybe sideways consolidation. Overall, if we do see pullbacks in the, like I just mentioned, in the other currencies, we could see either a sideways consolidation or a pullback in the dollar. And this will put a lot of relief on gold, which it surely will welcome. So let's look at gold next. Okay, so gold, let's start with this chart, which is gold versus the US dollar on the same chart. And this is a weekly time frame going back to 1977. The gist of this chart is this correlation coefficient here. You can see it spends most of its time in the negative territory. In other words, gold and dollar is negatively correlated. That makes perfect sense because gold is traded in US dollars. For this week, now we had a broken critical support, and I mentioned this one in my previous videos. And then even on Thursday, we're still seeing new lows being set. So it's just sometimes difficult to say exactly where it will bottom, especially if we, right now I'm not 100% if we are bearish or bullish for gold. We could be in the beginning stages of a bear market, or this could be a great buying opportunity. Okay, so here's the gold on the weekly time frame. Broken support here, but looks like it's possible we're attempting at least to bottom here. So if we do hold here and bottom, and maybe we'll rebound, and we will try to retest this 1243, and then maybe we'll hold there, and maybe we'll even come up to 1300 or so. Especially if the dollar doesn't appreciate much or just trades sideways. Here's gold on a weekly time frame going back to 2012. And one of my proprietary market breadth indicators is the gold breadth index. So this one doesn't only look at gold itself, it also looks at some of the gold miners' market breadth measures. And according to this measure, it did call a bull market here in March, or rather, let me see, somewhere around February here. And as of right now, we're not yet in a bear market. We did get a breakdown here below 1200 for gold, but gold has a tendency to overshoot the support levels and resistance levels. So I put more faith in my GBI. It has a pretty good success rate for the longer term calling of the bear or bull market. So for now, I still think we're in a bull market according to this measure. So gold breadth index is still bullish, so this could be a buying opportunity. In fact, here's the GDX, same thing. Let me basically it looks at the same thing, just GDX is much more volatile. So let me show you GDX on a daily time frame. Here is the GX on daily time frame. We had 3 tests of this $20 area, basically 1, 2, 3, and we have held that area so far. So this is definitely a good sign for the gold bulls and for GDX. So if we do, hold support here, we could, bounce higher and maybe at the very least see if we could take out this resistance 2250. But more importantly, if we could take out 2593 here and maybe even consolidate above the moving averages. There is a small bullish divergence right now. This advanced decline line, advanced decline volume line. So you can see that we have not yet made a high above this area here, so we can see we're still kind of below this area, but you can see that advanced decline line did make a higher high. It's very mild still, so slightly higher highs here on advanced decline line. So that's certainly a positive sign. Whether or not we will see further move up in the gold remains to be seen, but this is so far a positive sign, so to speak. Actually, I wanted to show another chart that's related to gold miners, and that's XME, Metals and Mining ETF, and it is hitting all-time 52-week highs rather, and versus the GDX, which hit 52-week highs back here in August and then sort of unraveled. So XME actually contains about 21% of the stocks that are also involved in precious metals and mining, and the rest is 78% versus various steel stocks and aluminum, etc. stocks. But 52-week highs in this ETF also means that gold stocks are being bought via the XME. So, maybe we'll see further appreciation in XME, and this will certainly favorably affect some of the stocks that are within GDX. So to summarize, gold and gold miners are not yet in a bear market. However, the longer we stay around here, and possibly if we drop more, the more likely it becomes that we will enter a bear market, and then security will be making lower lows and lower highs, lower lows and lower highs. So the big story, of course, was that OPEC came to some sort of a deal following 2 years of negotiations and arm twisting rather, and oil did pop on the news and is approaching 52-week highs, which were set back in October. Of course, here you can see we unraveled quite hard, and we were actually, and my subscribers were actually able to ride this entire leg down. So Where is this going? It's difficult to say. Brent crude did hit 52-week highs, so this is, you know, this 52-week highs are important. How important? I guess we'll see in the days and weeks ahead. Now I read some, like for example, here is a chart of the rig count versus the oil price itself. Now you can see that oil, this is in the United States, oil rig count was back at 1800 or even almost 2000 back here in 2015. Excuse me. Now then oil took a big dive here, and of course it makes perfect sense. The rig count also went down. So the rig count was like very low here in July of this year, but now oil is appreciating in price and rig count, lo and behold, is also going up. So there's a very good correlation between the two. So what this is telling me is this. Yes, they're going to cut production, but in response, if the prices will increase, United States producers will simply put more rigs online. So the net effect of this, tug of war between increasing supply and not strongly increasing demand is that prices could just stabilize and maybe trade in a band of like between like $62 and maybe a lower band of 39 or so. As far as very big moves, maybe we're over these big moves and maybe oil will just kind of trade sideways for the next few months or even possibly years. So, I'm not sure exactly if we're going to see strong moves, immediately, but like I said, maybe we'll just simply stabilize. That's also a possibility. Here's natural gas. I kept mentioning that once we broke out above this resistance area, we basically became bullish. We had several retests of this breakout. Latest one was just beautiful. We came down here, had several hammer-like candlesticks, and then we just rallied to the 52-week highs. In fact, on the weekly time frame, we closed the gap from 2014 just this week. So very impressive move in the natural gas. You can see the lows here were at $1.62 just in March of this year, really. And now we've moved 120 some percent up to 52-week highs. So this is looking great, I think. Maybe we'll see again, maybe sideways consolidation. Possibly we come down like to this area, or maybe we can just continue higher. It all depends on the supply and demand for natural gas. As far as technical picture, I think this is quite bullish, and we could see further appreciation for natural gas prices. And finally, I wanted to show sugar, and this one kind of came down relatively hard. Came down just on Friday, came down to the 200-day moving average. So maybe we'll hold here. There is support from this lows here. Maybe we'll hold here and rally from here, because these are 52-week highs. Here's a weekly time frame. In fact, these are multi-year highs. And you can see that we were doing nothing but dropping in the past, couple of months actually. So here's that support levels at 0.1871, around here. So yeah, it's possible we're gonna hold here and maybe rally from here. Alright, if you like what you're hearing, please take a look at MasterChartsTrading.com and please stay tuned on how to find us on the internet. Thanks a lot, bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.